Hi everyone, this is Stuart. Lots to cover today. A disappointing jobs report, a check on market valuations, competition heating up for Nvidia, and Google's favorable antitrust ruling. On the jobs front, the August payroll numbers were weak. Non-farm payrolls only rose by 22,000 for the month, well below the consensus expectation of 75,000. The unemployment rate ticked up to 4.3%, the highest in 4 years, and most concerning, youth unemployment now stands at 10.5%. This all comes on the heels of large downward revisions to employment the last several months. The key question for markets and the Federal Reserve is whether the economy is now slowing. Given the slowdown in the labor market, the Fed is all but sure to lower its policy rate at its meeting next month. Markets fully expect a 25 basis point cut and up to 3 by year end. While lower rates would help borrowers, with the caveat that 10 and 30-year interest rates matter much more for the rate-sensitive housing sector, we think that the general health of the economy and earnings matter much more for the direction of the stock market. As to the stock market, valuations remain generally elevated. That's not to say there's a lack of investment opportunities or that many companies are not deserving of premium valuations given their growth and profits. However, as this chart from Deutsche Bank shows, high cyclically adjusted price to earnings ratios tend to correspond with lower forward nominal and inflation adjusted returns over a subsequent 10-year period. Again, the past is no guarantee of future results, especially given changes to the nature of the economy over the last 150 years that this data covers. For instance, technology and services of today are far less cyclical than industrials of the past, with better operating margins. Still, the general point holds that the higher the valuation entry level for one's investment, the higher the hurdle for future returns. One part of the market that may be ripe for investment consideration is capital-intensive firms. On our last correspondence, we discussed how technology firms are shifting from a capital-light to capital-heavy model as they spend hundreds of billions to build out data center infrastructure for artificial intelligence. If AI proves as transformative as we think, it may be that the historically capital-intensive firms, rather than the emerging new ones, stand to benefit most from improvements in their businesses' margins and profit profiles. If AI can enhance both their productivity and help lower their cost structures, the performance gap between capital-intensive and non-capital-intensive firms that has defined the computing era for the last 35 years may narrow during the AI era. On the subject of AI, a very active last week in the chip space. A week ago, news from China came out that Alibaba was making progress in its GPU chips that are several generations behind Nvidia's. This week, we learned that OpenAI will begin mass producing its own custom chips with Broadcom starting next year to be used mostly for inference purposes rather than training models. An in-depth article from semiconductor analysts at SemiAnalysis also highlighted Amazon's progress with its own custom silicon efforts with their Trainium 2 chips to service Anthropic. Google is by far the leader in proprietary chips with their tensor processing units, otherwise known as TPUs, that serve as the backbone for their compute efforts. The AI market for semiconductors is massively expanding, and we still expect Nvidia to grow with it. However, competition is heating up both from abroad and from current customers for whom Nvidia's chips are a major expense. We doubt Nvidia's results are impacted by this much over the next few years. But there is a longer-term question about market share, and the stock may trade sensitively to any changing assumptions. Finally, we wanted to note Google's big day in court. The company received a favorable ruling in the Justice Department's antitrust case, avoiding harsh penalties that would have required separating out its Chrome browser and ending its mutually beneficial relationship with Apple, in which Google pays to be the default browser on Safari. As we discussed earlier in the summer, we still think Google's valuation discount to its peers and the broader S&P 500 is unwarranted given its growth and strong position across many parts of the tech ecosystem, most importantly in AI. With the legal overhang settled for now, we would not be surprised to see that valuation discount close. Thank you for tuning in, and please let us know if you'd like to discuss anything we covered today.